of both Credential Asset Management and Credential Securities, which I'm hopeful many of our guests today are utilizing those services. In his role, Doug researches case law, legislation, financial media, and helps prepare our clients, our owners, and financial advisors. He publishes articles, he does webinars like this, public seminars, and assists, some of our advisors and owners who have really complex cases and helps, all of us move those cases forward. Doug's had roles in both life insurance and the investment industry and ran an estate planning law practice. So he's certainly bringing a lot of practical insight to this conversation today. Doug is a pretty regular media contributor. You may have seen him on things like the Globe and Mail, National Post, Toronto Star, CTV, Sirius XM Radio, Yahoo Finance. There's a long list here. I'm not going to read them all. Doug might get embarrassed. Doug holds a degree in business administration, a Master of Laws degree with a specialization in taxation. He's also a trust and estate practitioner and a certified financial planner, making him certainly eminently qualified for this conversation today. Professional qualifications aside, Doug gets great satisfaction when he hears people say that he actually speaks English when he's speaking law, when he's speaking tax today. With that, thanks, and everybody, Doug Carroll.
Thanks, Paul. I'd say that this topic, despite the title being about tax refund, the things that we're going to talk about are more in the nature of financial planning and specifically about savings to make best use of that tax refund that you get, and obviously it originates from the tax system or your interaction with the tax system, but it's more here about the kind of routine you can get into to make sure that you're making best use of it with your savings. I'm before I launch into the topic itself, and I'll just if we can advance to the contents of the topic here, and I'll let people see that. I imagine that quite a lot of people will not have yet filed their taxes, and when you do, of course, if you have a refund coming, then that's what we're talking about here. But I just wanted to touch on the issue of what will happen or what may happen with people who receive some benefits, the emergency recovery benefits from the government, and what happens with those, because just today the Canada Revenue Agency issued a frequently asked question, or a question page, that if you have received any of the benefits, the emergency response benefit or the recovery benefit, the student benefit, the caregiving benefit, all of those benefits, it's really important that you're clear on reporting those and whether they have been taxable. And so what you can anticipate will happen when you go to file your taxes. So if you do not have your T4A, having received the benefits over the course of last year, then you can go into a search engine and punch in the words "questions about your T4A CRA," and that should bring up the first hit to take you to the question page that the Canada Revenue Agency just issued today to help you out with that. So I'll leave that aside and get onto the topic here. As I said, a lot of this is really about savings routine. So I'm going to take you through these items and just highlight a few points that are places where you can make your refund that you received even more beneficial to you than if you spent it on a cup of coffee or something that you enjoyed but did not push you along in terms of your savings. So one of the things to look at in the first place is that quite often the reason why people receive a refund is because the amounts that you contributed into your RSP are amounts that originated because you are an employee and your employer did not know that you were going to make additional contributions to an RSP outside of the workplace, and therefore too much was withheld on your on the money that you had on your paycheck than should have been the case. So what you can do with the with the money that you receive is to put it forward into your RSP to allow you to get your savings process going this year, over the course of this year. And if you're in that position where you received a refund when it was because you had too much withheld by your employer, then one of the things that you can do is file with your employer a T1213 form, which tells your employer not to withhold quite so much for you over the course of the year. And it's one of the things that you do that for is if you are planning on making those contributions outside of the workplace. So you get the use of that money rather than getting the refund. As much as it's nice getting the refund, effectively you've given an interest-free loan to the government until you claim that when you filed your taxes. So you may want to prefer to receive a larger net amount on your paychecks rather than getting the big chunk when you get your refund next year. In terms of how much you can put in, here's the figures right now on the slide that shows you that the current room that is available to you, it is based on your 18% of your previous year's earned income. So here in 2021, it's based on how much you earned last year in 2020. So 18% of that figure, plus any amount that you carried forward that you didn't use in previous year. That's how much room you have available. The maximum room that you'd be entitled to earn based on your income last year is just over almost $28,000. So that's making use of your own RSP. And then we can also look at the possibility of making use of a spousal RSP. So that's our next topic that we'll move on to. And with the spousal RSP, again, it's your RSP room that determines how much you can put into RSPs, but you have the option to put into your own RSP or into a spouse's RSP. And what this does for you is you between the two of you as spouses are able to do a bit of income splitting in that when you put it into your spousal RSP or your spouse's RSP, then your spouse will be taxed on the withdrawals on that when the money comes back out of that. And some people might say, well, didn't we have the new or relatively new rules of pension income splitting? When I say new, that goes back to about 2008 that the pension income splitting rules came into play, where when you have pension income, registered pension plan or RIF income that you receive, up to 50% can be split over to your spouse. So why would you bother with a spousal RSP? And the reason why you would do that generally is that under the pension income splitting rules, amounts that come out of a registered pension plan, there are no time limits or age limits on when you can make use of the splitting rules. But if the amounts are coming from a registered retirement income fund, a RIF, then you must be 65 in order to make use of the pension splitting rules. Whereas if you put money into a spousal RSP, and so your spouse actually owns that RSP and is the annuitant on it, then your spouse can take that money out of that RSP, draw from it, and he or she is taxed on that at that time, and it doesn't have to wait until age 65 to make use of that. So that's the reason why we can make use of the spousal RSP as well as the pension income splitting rules. So next topic that we want to look at is if you have made use of an RSP loan, then what can you do in that situation? Well, RSP loans are available to from financial institutions generally to help you out with getting money into an RSP. And when you do that, essentially what you're doing is you're taking out that loan in order to get going when you don't already have the cash available to go into your RSP. Usually it's in what we refer to as RSP season, the first 60 days of the year, that you might take money to come from an RSP loan to then get your RSP going. So it's a boost that you have available to you. The concern that you can get into is that when you have that money coming out, then or when you have the money that comes from the loan, you are putting it into an RSP that is tax exempt, so it's tax sheltered, and therefore the interest on the loan, the RSP loan, is not deductible. So it's a costly amount to pay back that figure in terms of taxes. And also the principal that you borrow also has to be paid back, and that also is not a tax deductible amount. So when you make use of an RSP loan, then your first priority should be to get your refund that arises because you made use of the loan, to apply the refund against the loan to reduce down the principal, and as well then, because there's less principal, to reduce down the interest that you will pay on that loan. And ideally, you will pay off that loan before the end of the year. And once you get to the point where you have paid off that loan, then having gone through the process of allocating some of your budget from month to month towards paying off this loan, then maybe you continue on with that payment. But instead of paying off the RSP loan, you have that money going directly into your RSP, so that you're not in the same position next year of needing to take out a loan in order to get your RSP contributions going. So there's our RSP loan. So let's move on to the next topic then, and that is to look at reducing the mortgage that you have. And with the mortgage, you're getting yourself into a home by borrowing money to get to where you want to go to in terms of your housing, and most people do need to have some help in order to get there. And the drawback to that, if there is a drawback to it, is simply that you're borrowing money and you've got to pay that back, similar to the RSP loan, except this is a much larger borrowed amount, and you're making a commitment for many years and perhaps even a couple of decades out in time. So if you can pay down that loan sooner, then you're going to reduce down the interest you will pay over the course of that time period. You will get yourself to the point where you are mortgage free sooner. And although a tax refund as a dollar amount relative to a mortgage might seem a relatively small amount, over the course of time, if you're able to pay down that mortgage early on with some allocation of your refund, then the interest that you do not pay on the amounts that otherwise would be outstanding for many years or decades out in time will be a savings to you on your future cash flow, and will get you to the point where you are mortgage free sooner and give you a lot more flexibility on how then you use your finances out there into the future. Next item that I want to turn to is non-deductible debt. And to be honest, this one probably is the highest priority because of the cost involved with non-deductible debt. So there's no issue about making sure that you can live the life that you have and use money that is available from loans to perhaps bridge the time until cash is available to you to be able to live in the way that you want to, as long as you're not being too luxurious about it. So prudently using credit makes good sense. But if it gets out of hand, then that debt can steamroll out ahead of you and could be debilitating. It could be very difficult for you to get out of that debt in any near time frame, and perhaps you put yourself in a really difficult position. The non-deductible debt, because it's used for personal purposes, if you borrowed money, whether it's on a credit card or on an individual loan, if you use that money towards personal purposes, then there's no deduction on that, and the interest charges could be fairly substantial. So make sure that you have a plan of how you're going to reduce down that debt. And if you're in that position where you have a substantial amount of this non-deductible debt, then a refund could be applied towards that to, again, reduce down the exposure you have towards interest out there into the future, and then get things more onto an even keel with your finances sooner, so that you can make sure that you can move on to the next stage of your life. All right, next topic that I want to talk about is something about going back to the savings, which is the tax-free savings account. And the tax-free savings account, which has been around for well over a decade now, is a very flexible kind of savings program, which you can use yourself. So you could use some of the refund money to go into your own tax-free savings account. You could also potentially give money to your spouse, and your spouse could put that into his or her tax-free savings account. Nice thing about that is that whereas if you give money to a spouse, which goes into a non-registered investment, then the investment income could be taxed back to you as the person who originated the money that you gave to your spouse. And I'm assuming here that you, as the giving person, are the higher taxed person. With the tax-free savings account, you can give money to a spouse that your spouse puts into his or her TFSA, and there is no attribution. The income in a tax-free savings account is tax sheltered as it grows, and then when money comes out of the TFSA, there is no tax applying there either. So it's a good way to provide for savings for yourself and give yourself some flexibility, as well as potentially turning the money over to your spouse to allow your spouse to put money into his or her plan. And the other thing that you can do with this, what some people may do, is make use of the tax-free savings account as an interim place to put money, investment money that you might otherwise put into an RSP. So coming back to one of the original or the early point that I was making about you putting money into your RSP, so a non-workplace RSP, you've already been paid. You have the money that comes into your bank account by receiving those funds on your paycheck, and then you use those dollars to then make a purchase of an RSP investment. You could alternatively to making the purchase in the RSP investment, you could alternatively use your tax-free savings account, purchase the same investment choices that you otherwise would do over in your RSP inside of your tax-free savings account. And then over the course of the year, you will accumulate the value in that TFSA, and you may leave it there and not pull it out, but you have the option to take it out of the tax-free savings account towards the end of the year, possibly going over into the new year, and use the money once it comes out of the TFSA to then go over into your RSP. And what happens there is the growth in value of your tax-free savings account, and you don't know if necessarily things are going to grow from day to day, month to month, but assuming that we have growth over the course of time, then the TFSA is going to grow in value. And when you pull the money out of there, you get a dollar for dollar credit to put money back into the TFSA the following January 1st. And then you can use that money as it's grown up and put it into your RRSP. And then that makes for your RRSP contribution in coordination with your tax-free savings account. So the two can actually work very nicely in combination with one another, the TFSA and the RRSP. Next topic that I want to touch on is specific to education. And there are many ways that you might fund a person's education, your child's education. But the core of it is the RESP, the Registered Education Savings Plan. And with the Registered Education Savings Plan, we also have the opportunity to make use of Canada Education Savings Grants. The Canada Education Savings Grant has a few different components, but mainly it is a matching program where when you put money in, then the government puts money in to match what you put in. And the main contribution that will be matched is that you can get up to $500 of contribution from the government when you put in $2,500 in a year. So it's a 20% matching. And you don't have to put in the full 2,500. It's a 20% matching that happens when you put money into your RESP. Those two amounts, then, what you put in and then what the government puts in, are entitled to the tax sheltered growth within that plan. So though you are putting in money yourself, which is your after-tax money, so you've already been taxed on it, when it's inside of an RESP, it is tax sheltered. The growth on it is tax sheltered, and the government's contribution is not taxed to you, and the government's money is also tax sheltered as the two of those things then grow in value. And then when your child, your student, is at school and draws the money out of the RESP, the tax on the growth is taxed to the child. And the grant money that the government gives is also taxed to the child. But again, it's the child who is closing in on being an adult, being a post-secondary student. It's the child who is taxed on that. And so in most cases, You are contributing into this when you are at a high tax bracket, or certainly a relatively higher bracket compared to your own child, when your child is going to draw that money out. So the growth on that money, instead of being taxed to you, ends up being taxed to your child. And because your child has minimal income, then very little tax and possibly no tax will apply when your child withdraws the money from the RESP. So there's a whole bunch of ways that an RESP can be a helpful way to grow up the funds that are available for your child to go to school, to go to post-secondary school. All right, let me turn then to another program, which is specifically for disabilities, for those families who have someone who has a disability. Where you have a known need for someone who has a disability, then there will be financial needs that will attach to that. So making use of a variety of programs that will be available through the government will assist you. The disability tax credit first, as the way that you can reduce down current taxes, but also if you have someone who is qualified for the disability tax credit, then you can go further to make use of the Registered Disability Savings Plan, the RDSP. The RDSP can receive, you can put up to $200,000 into it lifetime. There is no single year limit on it. You can put any amount up to that $200,000 figure. But the government, what it contributes into it in a similar way as there are contributions that are matched with the RESP, there are matching grants for the RDSP, the Registered Disability Savings Plan. And the matching grants with the RDSP are very substantial. They're up to 300% of the amount that you put in from year to year. And the amounts the government will put in are limited how much they will put in a given year. So like I said, you could put in the whole $200,000, but you will only get grants in that 1 year. It's usually better to pay money into it over the course of time from year to year so that you maximize the amount of grant money that the government will then put into the plan alongside your money. And then similar to the RESP, when money is drawn out of an RDSP, it is the person who is the beneficiary, the person who has the disability, who is taxed on the growth of that money. And so again, you expect that there's going to be lower tax and perhaps no tax that will apply on the withdrawal of those funds. So lots of ways that the RDSP can help out for families who are in need of support because there's a disability need in the family. And then my penultimate point here is to turn to look at non-registered investments. So with all of the tax sheltering programs, there are some kinds of limits of how much money can go into them, or some limit as to how much the government will contribute in as matching grants. Or although I didn't mention them, the government also may contribute in depending on income level. If you're at a low to mid income level, the government may also be contributing in money that does not require you to make contributions. So it's what they call bond money, which is free to you based on your income level. So with non-registered accounts, there are no such limits. You can put as much as you wish into a non-registered investment account. It's all after-tax money that is going into the non-registered account. And with those non-registered accounts, you then can use that as a complement or a supplement to the usage of those tax sheltered plans. So it is usually the last of the places that you will put money in. You'll make use of those tax sheltering plans first, and then look towards the non-registered account. But it could be based on your tax characteristics, your income, and where your existing money already lies, how much you've already accumulated. It may be that it does make sense to allocate more towards non-registered investments than to put further money into one or more of those other tax sheltered plans. In particular, if you have substantial money that's grown up in RSPs and you're nearing the point that you're going to draw the money out of the plan, then maybe you don't want to put more money into that plan, because if you put more into the RSP, when it comes out, it is fully taxable. Whereas with the non-registered account, although you're putting your after-tax money into it, you don't have the same concerns about money being taken into income on an involuntary basis, because you are required to draw down your RRSP money once you hit a certain age, and that age is 71. So a lot of coordination may be involved in the non-registered money with your tax sheltered accounts, and that's where your financial advisor can give you some guidance on how to make use of all these things. And then the last thing that I'll mention is that I'm not saying to be totally boring, to not spend any of that money on things that you enjoy. Obviously, there's challenges that we have right now in this pandemic, being able to get there and travel, as a lot of people like to do with their refund money. But things will emerge from this. Hopefully, we've got these vaccines going, and we'll be able to spend our money a little bit more freely and live it up a little bit. So I'm not suggesting that you use only savings places, but make sure that you keep it in balance so that you're treating yourself well now, but also make sure that you're saving so you can treat yourself well into the future. And then I'll bring it back, Paul, if you want to pick it up from there and see if we have any questions to touch on here.
No, fantastic, Doug. I appreciate this. A big smile on my face when you talked about not being boring and actually doing something a little bit fun with your tax return. Did make me smile. And we recognize that this has such a personal impact, that everybody's situation is a little bit different. Everybody's goals are a little bit different. Everybody's, the stuff that they're dealing with is a little bit different. So if you're not sure what's the right option for you, absolutely, we would encourage you to come in and talk to one of our Libro coaches. We're very proud of the team of advisors that we have, and we're very adamant in the fact that it doesn't matter. I mean, if you have $50 to invest or you have $50 million to invest, we genuinely have a coach, an accredited coach, an experienced coach who can help you with these conversations. So a couple questions for you, Doug. Obviously, to get a tax refund, as you talked about, you have to file your tax return. And some of us are still waiting for various contribution forms and different things from 2020, so that may not be done yet. But two questions for you here. One, any sort of tips in general about filing that return? And this follow-up question is, any specific tips for 2020, knowing that 2020 was a little bit unique? Things like the emergency benefit programs related to COVID, some of the new announcements with respect to working from home, etc. Any thoughts there?
Yeah, a couple of things on the COVID front. One thing is that the government announced that they would provide relief from interest for people who received the emergency benefits. So if you owe taxes and you are not able to pay your entire bill for taxes on time, April 30th, then the government has said that you will get relief. I believe that they're giving a year's relief to get those taxes paid. And that's unfortunately the situation, that those benefits, and particularly the CERB, the first one, those were paid in gross. And so people received those amounts and there was no withholding. And a lot of people probably wouldn't have been aware that the entire amount was going to be taken into income, and they may very well have spent it. And so this is the relief that the government is offering. What you have to be really careful about with that is that they are giving relief on the interest, but not on late filing penalties. So you still have to file on time, the return itself, by April the 30th. And if you're in the category, and they've got requirements involved with how much income threshold you have to be up to in order to get the relief, then if you file on time, you will get that interest relief. But if you file late, then you're going to have late filing penalties, which are in addition to the interest. So do make sure that you do in fact file on time with your 2020. And oh, sorry, what was the first point that you'd raised there, Paul?
It was really just a general, any top tips in general. I mean, I'm filing on time if you owe money. Absolutely, that would apply in any year, but just wondering if there would be any sort of high level top tips for your tax return that you wanted to share.
Well, I'd say that don't don't rest on or lean on that April 30th date as if, well, I have until April 30th, and so I'm going to wait till April 30th. If you get your filing in right now, if you file online, then the government says that they'll take no more than or roughly 8 business days to get back to you with your refund. So why not do that now and get that into your hands rather than pushing it right up to the end, putting stress on yourself and letting the government have whatever that refund money is to work with when you can have it back to yourself. So I'd say that once your slips are all in, then go ahead and file. I'm like you said, waiting on slips. I was actually sitting there in front of the computer last Saturday and going, all right, I'm ready to go. I got one missing. So I'm just sitting there and thinking, okay, well, I guess this is going to be next weekend. Hopefully that'll be in and then I can go ahead with things.
Yeah, no, absolutely. Yeah, I should have been more specific. When you owe money, make sure you file by the deadline. If they owe you money on the interest-free loan, because they don't pay you interest the other way back, and you've got
Yeah.
everything, yeah, get that in as soon as possible. Absolutely. Question from one of our guests on the call. In your view, for preparing tax forms, should you do it by yourself or with the help of an accountant?
Well, I think that it's subject to your comfort level with doing it. To be honest, the software has gone, just leaped forward over the years and decades to the point where if you have a straightforward kind of income profile that you receive only employment income or you receive only government benefits, that you don't have a business or a rental property, those types of things, then you're probably okay to use the software. I'm not going to give you an overt recommendation to do that, but you're probably okay with that. But where you have some of those complexities, then yeah, I think that it's worth speaking to a tax preparer. Whether it is actually an accountant, somebody who has those credentials, depends on the level of complexity that you might have. And the other one, actually, I'll add on. The other one I did make reference to as we were going through the main points there. If there are disability needs in the family, then you want to take a closer look at that and say, am I actually checking all the boxes that are necessary to get the benefits that I'm entitled to or that my family is entitled to? Once you've done that, it might be something that you do with assistance in 1 year so that you're clear on making sure that everything's good, and then maybe you can take care of it yourself thereafter. Maybe you don't need that help at all, but if you're unclear, then make sure that you look into that.
Thanks. There was a follow-up question. I'm not sure you're going to be willing to answer this one specifically, but I'll put it on the table about what tax software should I use? Which one
No,
is
no, I'm
best?
not gonna. I'm not gonna answer on that. I mean, the one thing that you can do though, just the Canada Revenue Agency on its website. I have no idea what the link is, but they have a list of the qualified software providers that will be able to net file your return. And so, if you go onto the CRA website and do a bit of a search in their search engine, then you'll find that list of providers. And I use one particular that I've used every year for about 15 years, but I think that I wouldn't say that they're indistinguishable one from the next. But if been given the I wouldn't say seal of approval, but they've been given the listing of qualified as far as CRA is concerned, then I think you're in decent shape to be able to use the software.
Great, great feedback. Yeah, I've personally been doing it myself for about 10 years now, and just that I've been using the same provider because they have last year's information, which makes
Yeah,
filing this year's return that much faster. So
yeah,
the first year might take a little bit longer. The second year will probably be a little bit quicker, assuming your personal financial situation hasn't changed over
yeah.
dramatically.
Yeah. Oh,
Um,
by the way, just before we go off of that,
sure.
just on those tax slips, if you have not received tax slips, if you're expecting them in the mail, maybe you changed employers, maybe you're not in continuing contact with one of your employers. One of the things that you can do is when you go on to your My Account, your CRA My Account, then it will have the T slips that have been filed by those organizations that are required to do them if they have already filed. So they may have filed it so that it's in that My Account, so you can get the digital version of it, even though you haven't received the paper one in the mail. So if you don't have it in your hands, check in there. Maybe that's the way that you can get a hold of that and get going with your return calculations.
Yeah, no, that's a great example. I mean, and I would say that today all of our investment options at Libro do have the option for or electronic accounts, and all of those options also allow you to go into those accounts and generally access all of the tax forms that you would need, generally available a little bit quicker than our friends at Canada Post. No disrespect intended to Canada Post, they just can't possibly be as fast as an electronic update online.
Yeah.
Um, and then, yeah, one question we get a lot, and I know you touched on both, using RSP contributions and tax-free savings accounts, and there's a lot of value to that. Um, Amazingly, we do come across a lot of our owners that have, beyond their emergency savings account, have significant non-registered cash type investments and don't have a tax-free savings account, or at least we're not aware that they have a tax-free savings account. So great reminder there to use those registered options where you can first before you make stuff taxable. But question we receive a lot. Our coaches get this all the time. Should I do a TFSA? Should I do an RSP? Should I do both? Yes, do both if you can. But what's your general rule of thumb to those kind of questions when it comes up?
Yeah, I'd say that if you've got lots of cash and you can do both, likely you're going to do both of those things. There's not a lot of drawback to the TFSA. The RSP, what you have to be careful about is the money coming out of it is going to be taxable. And if you've already accumulated a substantial amount, and you project out how you're going to draw down your money in your later years in your retirement, then you may have so much in there that it's going to push you up into higher tax brackets. So you want to be aware of that possibility. Just as a general comparison between the two, if you expect to be in a lower tax bracket later on, then the RSP, because you're taking your tax break currently at your relatively higher tax bracket, you're going to be better off making use of the RSP, because both of those plans, the RSP and the TFSA, in the middle stage of things, there is no tax that applies on the growth of the money. With the RSP, you get your tax break early on, you get the tax sheltering, but then you're taxed on the back end of things. With the TFSA, it's already after tax money. You get your tax sheltering, and then it's non-taxable coming out. So if you expect you're going to be a lower tax bracket, and certainly if you're in the earlier years of your working time and you're saving towards your retirement, RSP is probably going to be your default choice. But if you were at a relatively low income level from where you expect to be later on to draw off that particular investment source, then maybe the TFSA is the better way to go about it. That's one of those things where you have somebody, and I'll say an engineer, you got a student that comes out of engineering school with great prospects for high income earning later on, starts into their first job, gets paid at an entry level for engineers, and gets their paycheck with a certain amount of RSP room, because you get 18% of that for RSP room. The thing is, you're going to be at a higher tax bracket later. Maybe what you do is you take that amount that otherwise you would put into your RSP, you put it into your TFSA, and then when you get out there further in time, when you're at that higher tax bracket, pull it out of the TFSA and put it over into the RSP at that point. And there you're coordinating the TFSA and the RSP together to make the best use of the tax characteristics of the two.
All right. Thanks, Doug. We're about ready to wrap up. We don't have any questions pending in the queue here that I can see. Anything that sprung to mind before I wrap up today as closing thoughts for our guests on today's call?
Well, I guess the only thing I would say, and we're talking about the refund stage of things, people sometimes will talk about this as being tax planning. Your tax planning needs to be during the year as opposed to when you're filing your taxes. Filing your taxes is tax compliance. So as you get your refund, you're given the opportunity to start your 2021 tax planning right now, that then you'll reap the benefits of next year when you do your tax filing in 12 months from now. So yeah, I don't suggest that you save absolutely every penny, but try to use it to some extent to beef up your savings and enjoy the other part, live it up a little bit.
Oh, that's great. Thank you, Doug. And I talked at the beginning of the call about my self-titled VP of Investor Behavior, and that really, frankly, relates back to the planning process. We have accredited financial planners in our team that want to help owners. We'd love to talk to you to do this advanced planning so that we can think not just for 2021, not just for 2022, but let's think a little bit further out. The planning is going to help you likely, potentially save you tax money. And we know that investors that work with an advisor, despite all the commercials that might say otherwise, investors that work with an advisor have more assets at the end of their investing journey as a group than investors that do it alone. So we'd love to talk with you. There's options on the screen here on how to book meetings either through our website, call our contact center at Libro Connect, reach out to a coach if you already have one. We'd love to talk to you. Genuinely appreciate your attention today. Hope you found this information useful. My thanks to Doug Carroll joining us for Aviso Wealth. On behalf of our colleagues at Libro Credit Union, thanks for your time.